Banks are institutions that play a critical role in our economy, providing financial services such as loans, savings accounts, and investments. However, banks can also be vulnerable to collapse, which can have severe consequences for both the financial system and the broader economy. Here's how a bank could collapse. Firstly, banks rely on customer deposits to fund their lending activities. If too many customers withdraw their deposits at once, the bank may not have enough liquid funds to meet their obligations. This is known as a bank run, and it can quickly spiral out of control if other customers become worried and also withdraw their funds. Secondly, banks are exposed to various risks, including credit risk, market risk, and operational risk. Credit risk refers to the risk of borrowers defaulting on their loans, while market risk refers to losses due to changes in market conditions. Operational risk can arise from internal factors such as fraud, errors, or inadequate systems. Thirdly, banks can be affected by macroeconomic factors such as recessions, inflation, or changes in interest rates. A recession can lead to increased loan defaults and decreased demand for loans, while inflation can erode the value of bank assets. Changes in interest rates can also affect a bank's profitability, as they impact the cost of borrowing and the interest earned on loans. Fourthly, banks are subject to regulatory oversight, which can affect their operations and profitability. Regulations are put in place to ensure the stability and safety of the financial system, but they can also be burdensome and costly for banks to comply with. Finally, banks can also be affected by external shocks such as natural disasters, political upheaval, or cyber attacks. These events can disrupt bank operations and lead to financial losses. To prevent a bank collapse, banks engage in risk management practices such as diversification of their loan portfolio, stress testing, and maintaining adequate capital reserves. They also engage in liquidity management practices such as maintaining sufficient reserves and monitoring deposit flows. In addition, banks rely on the support of the central bank and government during times of crisis. The central bank can provide liquidity to banks in need, while the government can provide financial support or bailouts. However, if a bank's financial situation becomes dire, it may be forced to declare bankruptcy or be liquidated. This can have ripple effects throughout the financial system, as other banks may also be affected by the collapse. In conclusion, while banks play a critical role in our economy, they are also vulnerable to various risks and factors that can lead to collapse. It's important for banks to engage in risk management practices and for regulators to oversee their operations to ensure stability and safety.